Hey guys, it's Cody Kessler coming to you live from KLA in Rockville, Division of Homebridge Financial Services with today's episode of KLA Now. Today's topic, when and how should I lock my mortgage rate? I gotta tell you, this is something that we are constantly approached with. Doesn't matter whether we're talking to somebody who's buying a house or whether somebody that's refinancing. And it seems to be pretty prevalent right now because everybody is talking about refinancing because of where rates have been. But very few people actually know where mortgage rates come from. There's a lot of misconceptions and people just don't understand what's going on or what they have the ability to do. So they rely upon the bank and they rely upon the loan officer to give them advice. And as you guys all know, loan officers are not exactly known for being trustworthy. So we want to try to give you some good information today so that you can protect yourself as you go through these transactions. So let's kind of start with topic number one that we want to discuss. Where do mortgage rates come from? Most people really don't understand exactly where mortgage rates come from, how they are put out by banks, and then simply, most people think that the federal government actually is the one that dictates that. So all of those things are pretty much inaccurate. Mortgage rates come from mortgage-backed securities and the trading of those securities. And so a lot of people, they're known as MBSs. So an MBS price, where do they come from? They're an equity. They trade just like a bond, and they trade inversely of the equities market. And an equities market in financial world, that's the stock market. And they trade very low risk, low yield. So they're a safe haven. So a lot of people really, again, don't understand how to follow this. So let me take you to a website. It's one of the best places to go. Even if you don't have a financial background, and that is I'll show you here a quick website, mortgagenewsdaily.com. Okay, and you can go right to where /MBS, and you can see where mortgage-backed securities are pricing out in the market. And this is actually a live website right now. We're showing you a month back, and so if you look at this, you can actually see where we are today. And if you look at it at 720, you see that little red square, but you can see that we're on a trend where we've missed the peak. So if you go back to that high point right there where that red market is, where it's almost reached 105.89, that was back at about 7.7, right at the peak of the market. So as you can see, those prices have come back down, which is why you've seen rates go up. So, rule, when mortgage-backed pricing is coming down, the actual interest rates are going up. Okay, so great information. Again, this is where you want to go to kind of to judge where the market's going, where interest rates are going. So if you have questions about this, obviously always feel free to reach out to us. But certainly you should be talking to your bank, talking to your loan officer about this information. All banks go off of mortgage-backed security pricing to put out their interest rates. Fannie Mae, Freddie Mac, Ginnie Mae, all the private lenders, portfolio lenders, jumbo lenders, anybody that's doing mortgages, they're looking at this to determine where they're going to come into the marketplace. So if interest rates are starting at Fannie Mae based off of mortgage-backed security pricing, that they go out to all the banks that actually securitize loans with them, and that bank looks at things like how much does it cost them to actually do a loan. So Homebridge has a cost of doing a loan. Wells Fargo has a cost of doing a specific loan. So they take those costs and they build it in to the interest rate. The interest rate is going to dictate how much money that bank is going to make over a period of time, or more importantly, it's going to dictate how much money that bank makes when either they securitize that loan or sell that loan off on an individual basis to a larger bank. So, that's really where interest rates are coming from. The misconception that the federal government dictates rates is incorrect. That actually talks about prime. Prime has nothing to do with mortgage rates, guys, okay? So prime, which sits at 3.25% right now, that has to do with credit cards, auto loans, lines of credit, home equity lines of credit, things like that. It has nothing to do with fixed rate first trust mortgages. So now that we're done there, let's go to the next point. What do we do when we're talking about purchases versus refinancing? They are similar, but there's some drastic differences in how you want to approach locking the rate. First, it doesn't matter whether you're doing a purchase or a refinance. You want to lock that rate as soon as you either get a contract or you green light that refinance, meaning that you say, yes, I agree to these terms, everything is good to go. There are a few banks out there, Homebridge being one of them, that on a purchase, we offer what's called a lock and shop, where you can actually lock your interest rate for a period of time without having a ratified contract. You don't even have to have a property address. So it's pretty unique when it comes to that. But not every bank offers those. Most banks make you wait until you have a ratified contract, and then what you talk about is the term and the lock period. How long do you need to lock that loan for? So with a contract, you have a very specific start date and a very specific end date, which is your settlement, your closing date. So you need your lock period to go through that date. So are you talking about a 30-day lock, a 45-day lock, a 60-day lock? The period, or that lock period, determines how your interest rate is impacted. Markets are usually moving in about 30-day increments. That's how securities are sold and delivered every 30 days. So as you go out beyond that, it makes it rather difficult actually for companies to hedge, especially in this market, against what the market is going to do. It's difficult to predict that. So the further out you get away from 30 days, the more risk is associated with the market moving. Therefore, you've got higher interest rates associated with that. It's always better, in my opinion, to take the slightly higher rate than it is to pay the points. But then that's up for you guys to decide, because it's going to be determined on how long you're going to stay in that property. So let's talk about refinances real quick, just in regards to how long should you actually be taking a lock there, because it's not a contract. You don't have a set period of time. The bank is usually the one that determines this, because they've got a process. Most banks, especially in a market where there's lots of refinance volume, are a minimum of 45 to 60 days. They won't let a refinance close in less period of time than that. So you want to ask the loan officer, how long is this lock for? What's the process? How long is that going to take definitively? And what do I need to do as the client in order to get a shorter term period? The reason that most of these things, the refinances, are delayed that far out, the client's not prepared. They don't get documents to them in a timely fashion. They don't get disclosures back. But there's also delays on the lender side just because of the sheer amount of volume that's walking in the door. So as a consumer, if you want to get that shorter lock period with the lower rate, have your documents prepared. Be ready to move very quickly and get everything to the lender in a very short period of time. As you're going through this, some of the things that I want to point out is, if you lock right away, a strategy that you should always be aware of is, one, a lender has the ability to float your interest rate down, okay, at any point throughout the transaction. It's just a matter of whether they actually do it or not, or what their policy is. Are they going to charge you money for it? Does the market have to come down a certain amount? But there are companies, again, Homebridge, we have a very liberal float down policy. We don't charge for it. If the market actually goes down even a slight bit, we have the ability to give our clients the ability to get that lower interest rate. It's in your benefit. A lot of banks don't look at it like that, and they should, because that's just what's best for you, the consumer. But you need to ask, what is your extension policy and what's your float down policy? Because if they can't float you down and you take a 30-day rate lock, but you go past that 30 days, well, who's responsible for that delay? If the bank's delaying it, are they going to pay for it? Or did you delay it and you're going to be stuck with that extension fee? You want to know how many days you can extend for beyond the initial lock period. And usually they go in increments of 7 days, 7, 15, 30, things like that. And there's a charge for it. 7 days for 1/8% or a point for every 7 days here. So it does actually, in a lot of ways, financially come out better to take the shorter term 30-day lock with the lower rate. And then if you go over those 30 days, to pay for it in cash for the extension, especially if you're going to be in that property for a long period of time. It definitely makes sense in the long run. So the next thing, we're going to talk about buy downs and points. So I've been doing this for 12 years, and there's really never been a time in my 12-year career where I have actually recommended people paying points to get a lower rate. And if you go back just over the last 5 years, that's really actually proven to be a very wise recommendation. The reason being is everybody keeps thinking that rates are going to go up. And if you're paying to get a lower rate and then the market comes down at that rate or lower, well, you've just wasted money. And then when it comes time to refinance, really you're making your break even that much longer. So unless you can definitively say that you are going to be in this property for an extremely long period of time, which right now averages between 7 and 10 years for buyers, and then they're looking for another property. It's not the 1950s and 60s where your grandparents bought a house and they lived in that house forever. People are much more, I don't want to say transient, but they're looking to buy up, keep up with the Joneses, things like that. So if you really are looking at paying points to buy it down, make sure that you firmly believe that this will be one of the last times that you refinance, and that interest rates, as I pointed out earlier at that website, are at the lowest point that you believe that they're ever going to be at. Those are the two factors that would validate you paying points to get a lower rate. There's a lot of banks out there that will actually tell you that it's customary to charge points. It's not. It is not customary at all. When you're shopping for an interest rate, you want to make sure that you get a flat market rate with no points on it, quoted to you by the bank, and then you can set the baseline to see how much you would have to pay to get a lower interest rate. Okay, so guys, I've walked you through a lot of great tips on how to cover yourself and when and how to lock as you go through this process. This is a lot of information that most lenders don't want you to know, but there's also a lot of this information that loan officers don't know to tell you. Make sure that you are discussing these things with your loan officer and that you feel comfortable and confident that they have a financial background, that they understand economics, but most importantly, do not let your loan officer sell you. Don't let them use the scare tactic about what the market is doing and how it's going to move. And if anybody says this is a great tip. Stand up and run. If anybody ever says this rate is only good for the next hour, that's the number one reason they're trying to sell you something, and they are continuing to perpetuate the terrible reputation that the mortgage industry has. Guys, this is not about selling anything. This is finance. These things should be presented to you black and white, cut and dry. Make a recommendation, but then, like we've done here, give you the information so that you can go and make an informed decision yourself. Being sold, I don't think anybody likes that. So, to recap, let's go through these points real quick. First, you want to lock your rate as soon as you possibly can. As soon as you get a contract or you decide that you are comfortable moving forward with that refinance. There is no point in waiting, because if the market goes down, you can potentially work with a lender that has a float down fee, but if the market goes up, you're chasing money, and that's not a good spot to be. That said, we don't want to play the market unless you're a financial expert. I showed you a website that you can go to, but unless you truly understand economically what's happening around the world, it's extremely difficult to predict what's going to happen day to day in the mortgage market. So if you're not doing this, and a lot of loan officers can tell you definitively, they have no idea what interest rates are going to do day to day, even hour to hour. So guys, you should be at least getting a recommendation, and if they don't give you good solid information, again, that might be a good indicator that you're not working with the right person. Next tip, you want to ask about extension fees for missing the lock period, and you also want to make sure that you're asking about what their float down policy is. Next, make sure that you get a full, detailed worksheet that talks about all the fees that are associated with locking that loan, okay? You don't necessarily have to get a GFE, but you do need to get a detailed loan worksheet. You want to make sure that there's no smoke and mirrors, that there's no hidden charges, no hidden fees, no points, discount points. You want to make sure that you know exactly what you're getting. Do not accept an email that has the terms of your loan written in the body of that email. That is not federally allowed. They are not allowed to do those things, and anybody that's doing that is not operating with your best interest at heart. Know the lender's business model. Know whether they're a mortgage bank and that they're going to service and securitize and then service that loan, or are they a direct correspondent lender, meaning that they'll underwrite that loan and fund it, but are they going to sell it off as soon as that loan closes, or are you working with a mortgage broker? They're all going to have slightly different policies, pros and cons to working with each, but know who you're working with. Last, do not let the originator sell you. And I'm going to use refinances specifically. I've been talking to a lot of clients lately, and every single one, if they are talking to another bank, they've all said that the loan officer has said, you know, if you can drop your interest rate a quarter, it makes financial sense. If you lower your payment by X amount, it makes financial sense. Guys, these two ways are absolutely insane. How does this loan officer know what makes sense for you? Because that rule of thumb, a quarter, that's not the case. I've looked at multiple refinances where we're dropping the interest rate close to a full point, and it still doesn't make financial sense. Here's why. Smaller loan amounts don't have the principal impact when you change that interest rate, but the refinance closing costs are the same as if it would be pretty much on $1 million loan. So your break even, how fast are you actually saving money, is way longer on most refinances for smaller loans. And if you're only dropping it 0.25%, there's a really good chance that it's just not going to make sense. And all you're doing is increasing your principal balance, and you're not going to really save the money that you're looking to save. It's a little bit of smoke and mirrors. So know what you're getting into. Don't let them sell you. Don't let them pull the old, hey, don't let them pull the old, hey, we're going to offer you this rate for the next hour. It's just not what's good for you. So guys, that is today's show. Greatly appreciate you hanging out with us today. Please go to YouTube, check us out, like us on Facebook, share this, tag it, and this is great information. If you are going through a mortgage right now, whether it's a purchase or a refinance, this is the kind of stuff that we love to get out to people. We want to make sure that we try to, we look at ourselves as the watchdogs of the industry. So thank you guys so much for watching, and we'll see you on the next episode of KLA Now.